De faculteit Bedrijfswetenschappen en Economie wil het eredoctoraat toekennen aan Mathias Dewatripont voor zijn bijdrage aan de implementatie van de Europese Bankenunie op basis van zijn fundamenteel onderzoek. Maar ook het feit dat hij zijn fundamenteel onderzoek heeft weten te implementeren in prudentiële regelgeving voor banken. Banken zijn cruciaal in ons economisch bestel omdat ze korte termijn deposito's omzetten in lange termijn kredieten. En dat maakt hen eigenlijk ook kwetsbaar, omdat deposanten hun bank kunnen wantrouwen en massaal hun deposito's kunnen opvragen.
Our firm is strong today.
Sommige banken zijn onvoldoende voorbereid op zo'n bankrun, omdat ze er eigenlijk rationeel op rekenen dat wanneer het brandt de overheid wel zal blussen, omdat ze too big to fail zijn. Zijn onderzoek gaat eigenlijk over als een bank failliet gaat. Moeten de staat dan die bank kopen, ja of nee? Of moeten we de aandeelhouders laten bloeden? Dus hij is heel duidelijk, hij zegt van kijk, natuurlijk moeten de aandeelhouders bloeden. Maar als de staat niet zou tussenkomen en de schade is nog groter, dan moeten ze wel tussenkomen. Het is precies om zo'n bankrun te vermijden dat je toereikende regelgeving moet ontwikkelen. Hij heeft daar zeker een instrumentele rol in gespeeld in het vormgeven van deze regelgeving. Als economist is hij een meester in het helder en duidelijk maken van moeilijke problemen en de problemen tot hun essentie herleiden om dan de juiste analyse te kunnen maken. Hij is een rolmodel voor onze faculteit. Hij heeft het beleidsstuur mee bediend en zo zijn fundamenteel onderzoek omgezet in maatschappelijke waarden. Hij heeft ook aangetoond dat niets zo praktisch is als excellente theorie.
And what does this mean for your financial future?
Dat depositohouders beter beschermd worden. Dat er betere regelgeving is voor banken. Dus dat is denk ik in eenieders belang voor elke burger. En dat is zeker een belangrijke verdienste van Mathias Dewatripont.
Goedemorgen allemaal. Goedemorgen aan alle studenten en deelnemers van binnen en buiten de Universiteit Antwerpen. Welkom in naam van onze universiteit, onze faculteit Bedrijfswetenschappen en Economie en in naam van onze decaan Koen van den Bent. We zijn zeer verheugd u hier allen zo talrijk te kunnen begroeten op deze masterclass, naar aanleiding van het eredoctoraat dat de Universiteit Antwerpen toekent aan professor Mathias Dewatripont. We beseffen dat het naar hier komen niet evident is en dan heb ik het niet over de werken in Antwerpen. Besef dat jullie opportuniteitskosten zeer hoog zijn en dat reflecteert dan ook de waarde die jullie hechten aan deze uitzonderlijke masterclass. Dank u. Mijn naam is Jan Boekaert, ik ben verbonden aan het departement Algemene Economie en ik heb de nominatie voor Mathias Dewatripont voorgesteld. Vandaag eren wij 5 personen die de Universiteit Antwerpen heel bijzonder vindt. Op 5 verschillende plaatsen van de Universiteit Antwerpen zijn er momenteel masterclasses, telkens gepresenteerd door de persoon die we deze namiddag een eredoctoraat zullen toekennen. Our plan for this morning is as depicted here. We know the schedule is tight and therefore I propose to introduce our keynote speaker for today. Allow me therefore to introduce the panel members when the discussion starts. Our Faculty of Business and Economics honors today Professor Mathias Dewatripont. Mathias is a world-class researcher. His scientific prizes reflect his academic track record, and our university wants to recognize the combination of Matthias's scientific work with his achievements as a policymaker in the field of prudential regulation of financial institutions. His roles in the Basel Committee on Banking Supervision and the Supervisory Board of the European Central Bank have been very instrumental in the creation of the Bank Recovery and Resolution Directive, paving the way towards the European Banking Union. And today, Mathias will present his views on the shape banks are in today, and he will speak for about half an hour, and he will also draw special attention to the Belgian situation. Mathias, the floor is yours.
Dank u Jan. Ik zou graag eerst de Universiteit Antwerpen danken, faculteit en promotor Jan. Een grote eer voor mij. Het is heel leuk hier te zijn. Dank u ook aan al de panelisten. Ik heb al een lange relatie met de Universiteit Antwerpen. Gedurende 10 jaar waren wij samen een IUAP-programma over de analyse van universiteiten. En ik moet zeggen, de fusie van jullie 3 instellingen is heel indrukwekkend, dus proficiat. Ik had ook een Frankie-leerstoel gekregen, waar ik sprak over contracten en organisaties. Dus het is altijd leuk hier terug te komen en in deze omstandigheden is het fantastisch. I was asked to talk about how sound banks are today. So it's great to be here to talk about that important topic and with first-class panelists. So I will try and be reasonably brief. I understand there is a question and answer session at the end. So my outline will be about so to what extent has regulation been corrected since the banking crisis that started 10 years ago in terms of liquidity, solvency and resolution. Where do Belgian banks stand also in comparison with other countries? How serious is banking overcapacity, especially given the new technological challenges? Things are moving fast. And finally, I'll spend quite some time on a topic which is much talked about these days. To what extent should we go towards pan-European banks, and what are the pluses and minuses? Okay, to take a very big picture, banking, as you know, is both useful and risky. Useful because we all need banking to get liquidity as households, SMEs. We have to go to banks to get credit. Banks, of course, are taking risks, and we want them to take some risks. They lend long, they borrow short. We want our money or deposits to be immediately available, but we want 20 years loans when we buy a house. And there is no miracle. Banks, and that is a bit more controversial, are of course very leveraged animals. And the question is, to what extent is leverage unavoidable, and to what extent can it be limited? We'll come back to that. And finally, while creditors of normal companies exert discipline on the firms to which they lend, many creditors of banks are depositors, you and me, and it's not our job to keep track of all what the banks are doing with our money, especially if we are insured. Therefore, we need regulation to make sure banks are sufficiently solvent and sufficiently liquid, regulation that will deal with systemic risks, because banks typically mostly fail at the same time when the macroeconomy is in trouble. And we need regulation to make sure we have credible resolution when a bank is going under, that things are stopped in a credible way fast enough. Now, I've done some research, in particular with Jean Tirole, on these topics, but I will not talk about that today. I will just sketch the big picture. Clearly, in 2008, we had insufficient regulation in terms of solvency, so the share of equity over total assets, rest being debt. Also in terms of very insufficient liquidity. no systemic regulation, and no credible resolution, and therefore we had huge bailouts. So taxpayer money being used big time in 2008, after the fall of Lehman Brothers in particular. The situation is better now. The so-called Basel III, before it was Basel II, means better solvency, the introduction of liquidity ratios to limit illiquidity, some systemic regulation called macro-prudential regulation. So all that stuff has improved. There is a question about has it improved enough or not. We can come back to that. Then on the resolution front, there is progress. The idea to say that you need bail-in rather than bail-out. So not only equity holder, but some creditors of banks should also take losses and not just the taxpayers. This is still work in progress, and I'm sure there will be questions about that in the panel. But we are moving in the right direction. To be a bit more precise on this question of resolution, since January 2016, BRD, the so-called Bank Recovery and Resolution Directive, is asking for at least 8% of bail-in, so losses taken before we can envisage a bailout. That's at least the theory. In practice, it doesn't really work that way, but that's the idea. The problem of that directive is that this rule was put in place before we could implement it, and implementing it without creating financial instability and bank runs meant that you would need to have at least 8% of long-term subordinated claims, so money stuck in the bank that can be wiped out if needed without creating a bank run. And right now we are not there yet, even if there is now a desire, but 3 years later, to ask for this thing for all banks with at least 100 billion euros of balance sheet, and the ability of national authority to require it even for smaller banks. I think it's a very good idea. It's an idea that Belgium, through the National Bank of Belgium macroprudential authority, is imposing, and I think it's a very good idea, because the last thing you want is to start putting at risk some bank creditors who have the possibility to run, because if they run, then the whole system can collapse, and that can be extremely bad for growth and therefore for the taxpayer. So that's a paradox, that in fact this kind of thing, if done in a bad way, could create more trouble than being a solution. As I say, so far we've been reasonably lucky that we haven't had to implement it, and I think it's better this way, but we need to make progress on that. Now this is for the big picture in terms of regulation. How has the banking sector evolved in 10 years in Belgium? Well, it has become healthier and smaller. So assets to GDP of all the banks in Belgium have gone from 4 times GDP, Belgian asset, to 2.3, 10 years. So almost halved. Moreover, banks have refocused on Belgium and on granting loans, which is the reason why we like banks. They grant loans to the real economy, so from 39% of the asset to 59%. And they are better capitalized on average from 3.4% to 7.4%, which is still not that much what you think about other sectors. But, and by the way, this shows smaller set of activities, more equity, but still in Belgium, decent return on equity between 8.6 and 10% each year since 2015. Close to the cost of capital. Now you might think of it, why is the cost of capital between 8 and 10%? How much do I get on my bank account? It's more like 0.5. Okay, one of the reasons why the cost of capital in banking is so high is because bank stocks are much more risky than deposits or whatever. One of the reasons is because banks are so leveraged. Capital of banks is only a small share of their total assets. So, but okay, right now the system seems to be working in Belgium for now, and better than in some other Eurozone countries. The European Banking Federation, for example, gives some numbers. Clearly, Belgian banks are doing well in these exercises called stress tests that are done every 2 years or so. Europe, the return on equity in Netherlands is close to Belgium, a little smaller in Spain, Italy, France. Interestingly, it's only 3% in Germany. So Germany is better at doing cars than at banking. And we'll come back to this. I mean, some large banks are not performing well. Deutsche Bank is a good example. Follow the newspapers. This being said, these are averages. There is a lot of heterogeneity. And, you know, in a number of countries, Belgium too, but for example, Italy, some banks are doing much better than others. In general, it's to be noted that US banks are in much better shape than Eurozone banks. So Eurozone banks are still somewhat fragile, and in some countries, like Germany, pretty fragile. And when you look at the stock market and market capitalization of banks, what do you see here? I have a couple of big banks. The best one is KBC. Market capitalization 8.7% of total assets. The worst one in the list is Deutsche Bank, 0.9%. So the market cap of Deutsche Bank is less than 1% of their assets. This suggests it's not. Now there is this talk about merging Deutsche Bank with Commerzbank. Commerzbank is also not great, a little bit better, 1.6%. Interestingly, the market capitalization of Deutsche Bank plus Commerzbank today, that would be the biggest bank in Europe, is still a little bit below KBC, whose size is much, much smaller. So, you know, some big banks today in Europe are not doing great. So, conclusion of that part, Belgian and Eurozone banks are more solid than in 2008. This, of course, we should hope that. They were so weak then and created so many problems. There is significant heterogeneity in performance. The system remains potentially fragile, however, in case of negative macro shocks, which may come also endogenously or be the result of specific policy events, think Brexit, political shocks, trade wars, and so on. And all of this while potentially facing so-called technological disruption. As the third topic I want to briefly allude to, as you know, banks today are busy restructuring and cutting branches and employment. There was ING Belgium, there is now Fortis. The process is clearly not over yet, especially since, for example, on the number of branches, Belgium is still significantly higher per capita than the Netherlands. And some countries are even further ahead. The Eurozone is lagging other parts of the world. For example, Alibaba, the Chinese Amazon, they extend loans to 11 million small and medium enterprise customers, and all of this through artificial intelligence algorithm. Nobody works there. You know, there is way to go. Then the question is, when the adjustment comes, who should pay for it? In particular, should it be the workers in the banks? Should it be the shareholders of the bank? We can have views on that. This digital challenge, of course, has the potential to significantly worsen the overcapacity in banking. An overcapacity which is already a problem in some countries, and for example, the reason why the return of equity in Germany is only 3% is because there they have something like 1,500 banks. Of course, many small banks, Interestingly, the smaller banks do on average better than the bigger ones. But, okay. So, frankly, all these things are potential challenges for the sector. Now, one solution that is being pushed forward by the authorities about improving the situation is cross-border mergers. In fact, the European Central Bank, for example, on record for saying we should have more cross-border banks. Big banks, some big banks are quite interested also to push in that direction. And it's a fair question, which I will discuss now for the rest of the talk. Will it be a good thing, allowing, for example, for more risk diversification? You know, if Italy is in macroeconomic recession, having a bank which is also in France, that would do better. That would be a way to share risks. Or does that mean we will exacerbate the too big to fail syndrome, the fact that some banks need to be saved with taxpayer money because they are so big that their failure will create systemic risks. In terms of cross-border merger and acquisition activity in the Eurozone, in the banking sector, it remains reasonably limited. Talking about 9% of the deals were cross-border in 2016, 15% the 5 years before. In the US, it's much more. If you compare cross-states, yeah, they have 50 states, the Eurozone has 19 member states, but still, there you have a lot of cross-border activity. Frankly, when you look at the 5 biggest countries in the Eurozone, Germany, France, Italy, Spain, and the Netherlands, domestic credit institutions amount to more than 90% of domestic assets. So only 10% of the assets are foreign-owned. Belgium is an interesting exception. We are the 6th country by banking asset side, and we are at 50%. That is ING Belgium, Fortis, BNP Paribas Fortis. So this is something to be kept in mind when thinking about the evolution of the banking system. Now, why does the European Central Bank push for cross-border banks? Because they argue better monetary policy transition, so money can move more freely from one country to the other, better risk sharing, lower home sovereign bias, which is an important thing, the fact that banks hold a lot of sovereign debt from their own sovereign, and if the sovereign is in trouble, that may mean that the banking system is in trouble and vice versa, the so-called doom loop. And possibly that could lead to faster resolution of the so-called non-performing loan problem, the idea that somehow you hide your problems by refinancing banks because you're not strong enough to take the losses. If you merge with a stronger bank, then that bank is able to take the losses and therefore to improve the problem more quickly. And finally, cross-border bank mergers imply fewer competition problems because the market share of the relevant national market is not changing. Frankly, all these advantages are relevant. It's still a bit of a paradox that today the big merger we are talking about is Deutsche Bank Commerzbank, not a cross-border merger, but clearly it has a political dimension. The Minister of Finance in Germany is explicitly pushing for this to create a German champion for German industry. We can have some doubts about that view. Now, one thing where, frankly, the argument is quite convincing, and we could even go further, is this question of home bias. The home sovereign bias is indeed a problem. In fact, the original sin of Basel has been to say, okay, lending to your own sovereign is riskless, so you don't need to have capital for that. That was politics. The problem is that the cross-border relationship could have an impact both in terms of reducing the sovereign home bias, but also the domestic economy bias. The fact that if your sovereign has a problem, then your economy as a whole will have a problem, and it's not enough to be diversified on sovereigns. You also should be diversified in terms of private economies, and there, frankly, it would be a good idea to push for cross-border banking. Now, on the other hand, there are the costs of cross-border banks and the ECB addressing these costs. The too big to fail problem is acknowledged, but the view is less of a problem now because thanks to Basel III, we have more solvency, more liquidity, we now have better resolution, and we have a better supervision system thanks to the banking union. The fact that cross-border banks may be helpful for risk diversification, but will lead to less cost-cutting because you won't take advantage of the fact that you can reduce the number of branches by merging domestically. The answer is that domestic mergers are needed too. Finally, the risk of contagions of big cross-border banks. The idea that, okay, if the diversification doesn't work because the problem in one country is too big, what about the contamination to other countries? The answer of the ECB, well, if you have proper macroprudential policy, you will be fine. I think that all these costs and also the mitigants are relevant. Still, I think we should keep in mind that the too big to fail problem is potentially bigger than what acknowledged by the ECB. We already have 8 banks, FSB list of global systemically important banks in the Eurozone, 4 French banks, Deutsche Bank, UniCredit, ING, and Santander. So we already have quite some big banks, and let's face it, even though now it is recognized that big banks can be more risky, and therefore there is a surcharge, capital surcharge for the first time, Basel III. Unfortunately, this surcharge is more than compensated by the internal model advantage of big banks. In fact, the fact that banks, and typically it's big banks that do that, can compute their risk weights using their internal models, and Basel III has just said that they, by 2027, so in 8 years, they cannot save more than 27.5% capital using internal models. So they have to be at least at 72%, which means they cannot gain more than 27.5 by 2027, and until 2022 they can gain 50% of capital. So it is a huge advantage, especially in more northern Eurozone countries where we haven't had big crises and therefore risk weights are pretty low, like in Germany, France, in Benelux. And that means that, let's face it, our capital ratios are not that demanding. And if you want to have an idea of an order of magnitude, there is this new very simple ratio called the leverage ratio, which is simple. It's simply equity as a percentage of the balance sheet, and that's at most 4% the requirement. So, you know, only 4% of the balance sheet of the bank is the minimum. So, since there is no significant prudential penalty for size, that means, and capital buffers remain limited, that pleads for caution as far as bank mergers are concerned. Especially if the incentive to do bank mergers result in takeover battle. We've had some takeover battles, maybe in AMRO 10 years ago. The evidence, the academic evidence on takeover battles in all sectors, beyond banking, is that around 100% of the efficiency gains are obtained by the shareholders of the target, because the fight leads to an increase in the price, and you can end up with what economists call the winner's curse. The party that wins is the one that was most optimistic and realized it was too optimistic. So the big prize, in a sense, is not winning. As I say, in Belgium, we were affected by that, the hostile takeover of ABN AMRO by Royal Bank of Scotland, Santander and Fortis that won against Barclays. Of course, next to the takeover battle aspect, it happened at the wrong time with excessive optimism by bidder, but these problems can never be ruled out. And frankly, it's not obvious that Basel III or the banking union would have prevented it, despite the fact that now banks are better capitalized and have more liquidity. So it is true that at the time the short-term wholesale financing of the merger was a key problem. So I think we should keep that in mind, because things can end up badly. Also, from the point of view of national interest, I think we should also keep in mind the symmetry or lack of symmetry of anti-takeover rules. You know, ABN AMRO, which was former Fortis Netherlands, is back on the market, on the stock market, but there are some golden shares that make sure that ABN AMRO will remain Dutch. Now, there has been a talk about partly privatizing Belfius. Are we sure that in the 10 years Belfius will remain Belgian? In a country where already 50% of the banking assets are foreign owned, while it's only 10% in the other countries. So, to conclude, cross-border mergers have potential advantages as far as financial stability is concerned, so the diversification aspect. They also have a potential to improve efficiency without reducing competition too much, but we shouldn't underestimate their potential costs, especially in a world where bank capitalization remains modest, where larger bank size does not translate into significantly higher capital requirements, quite the contrary, as we saw. And let's remember that the Belgian experience has shown that enthusiasm for bank expansion can at times end up in tears. Thank you.
Thank you very much, Matthias, for this thought-provoking talk. Very nice. Let me now introduce also the panel members and give them the opportunity to comment on certain specific topics from their perspectives. Let me start maybe with Professor Lucrezia Reichlin. Professor Reichlin is a leading researcher in the field of econometric modeling, forecasting, monetary policy, banking and finance. And previously, Mrs. Reichlin was full professor at the Université Libre de Bruxelles, Director General for Research at the European Central Bank, and currently she's a full professor at London Business School. Lucrezia is also a board member with many financial firms. Our second panel member is Professor Herman Daams, chairman of BNP Paribas Fortis. Mr. Daams is also chairman of KU Leuven, has been professor, among others, at Harvard Business School, and has also been leading GIMV, HIMF, for many years, and is also on the board of many other firms. Finally, may I also welcome Mr. Tom de Shane, who is the director at the National Bank. Mr. de Shane has a long career in the financial sector, like Deutsche Bank, among others, and has also been a board member and advisor with many firms in a diverse set of industries. And importantly, Tom is also an alumnus of our university. So thank you very much, all of you, for being here in Antwerp on this today's occasion. The panel members and our keynote speaker are, I think, very complementary to each other in the sense that they have different perspectives from which they look at the soundness of the European banks under the Bank Directive. And before we start, let me also please note that opinions stated by the participants are their personal opinions and not necessarily those of their organizations. Let me maybe start with Lucrezia.
Thank you. Thank you very much. It's a real pleasure to be here to celebrate Mathias Dewatripont, an old friend, an old colleague, and a giant in the subject matter. I'm not a banking economist, so I only talk from. I'm a macroeconomist, so I will be talking mostly about my practical experience as a director of a number of financial companies. So Mathias addressed many topics. Where are we now in banking regulation, liquidity, solvency, resolution, the status of the Belgian banks, technology, overcapacity of banks, and the pros and cons on mergers, cross-border mergers. So in my talk, I will focus on a subset of the first topic. So I will talk about resolution. Why have I chosen this topic? Well, because resolution, I think, is going to be what matters in the next crisis, if we're going to have one, and most likely we're going to have one. I also will move away from Belgium and will talk about Italy, not only because I'm Italian, but because our series of mini banking crises happen most of them after the new rules were in place. So I think the Italian case is food for thought for understanding, if something bigger would happen in Europe, how the new rules would work. So as we all know, the financial crisis of 2008 and 2009 exposed the presence of a massive moral hazard within the banking system. And this led to regulatory response that culminated in the creation of the single supervision mechanism, the single resolution mechanism. And the new rules, one of the main elements of the new rules is to put the burden of bank rescue on shareholders and subordinated creditors while minimizing the burden of taxpayers. So what have we learned about the effectiveness of these rules in the Italian case? So I will take Italy as a test, and I would say that the Italian experience is interesting, as I said, because the BRRD entered into force where, when the problem, so it had actually for two reasons. The first reason is because when the new rules were introduced, in the banking sector, there was a large amount of subordinated bonds convertible into shares that had been placed by the banks in retail investors' portfolios, and this had been done, after the financial crisis to recapitalize the banks in very tight capital market conditions. So the first problem is, the subordinated bonds in the hands of retailers, households mostly. The second problem was that the old system, on the basis of which Italy had always faced banking crisis, which was based on, state intervention and the use of deposit insurance, of a deposit insurance scheme which was present in Italy, well, this whole system was challenged by the interpretation of the new rules on state aid. So it was not, Italy was not able to use the old system, and so had to face the new rules. So there are 5 cases which are interesting. So I will go very fast in the interest of time, and I imagine that you are not all familiar with the Italian crisis. The first case appeared in 2014 was the failure of the problems of a little bank called Tercas, where Italy tried to use the Interbank Deposit Protection Fund, what I mentioned before, to cover losses and support the acquisition of this bank by another little bank, the Banca Popolare di Bari. Now, this intervention with the Interbank Deposit Protection Fund was not approved by the European Commission on the ground that it was state aid. And now, after a few years that this has happened, now the court has established that Italy was right in the use of this fund, and the Commission was wrong. So we will see what are the consequences of the ruling of the European Court on this ground. The second case was the problems of false mortgage banks, and this happened in 2015, just before the new bail-in rules were approved. So these banks were put in resolution in a hurry, just to avoid the bail-in rules, and they were put in resolution with burden sharing. Now, the importance of this case is that the retailers were compensated with public funds. The third case, which is more well known, is 2 medium-sized banks in the Veneto region. Here, these banks were put in liquidation rather than resolution, because at the end, after several negotiation and change of minds and so on, it was ruled that the banks were in public interest. There was a case for opting for liquidation rather than resolution. So the bail-in was avoided for that reason. And then there was a heavily subsidized sale of these banks to a bigger bank, Banca Intesa. The losers again were compensated with state, with public money. The fourth case is Monte dei Paschi di Siena, where it was the option, the strategy was to go for precautionary recapitalization, so with state financing, and again the losers were the bondholders were compensated. The fifth case is Banca Carige. This is still ongoing. So we don't know how it will end up. I actually was the vice chairman of that bank for 3 months. So, but what is interesting about this case is that in January 2019, there was a decree law that passed in Italy, which basically the decree will approves by principle a public recapitalization of Banca Carige, which is probably very much against the rules, but this has not happened yet, so we will see what will be the end of that saga. So what are the lessons here? I think that as in with fiscal rules, which in principles they're very rigid and very constraining, the rules of resolution are proved to be extremely flexible and maybe, in principle very, very rigid, but in practice extremely flexible. First of all, the application of the bail-in tool in the case where the banks were failing or likely to fail was always avoided, and always with different motivations, as I described. The second point is state aid was always deemed to be necessary. And this points to an asymmetry whereby the supervisory powers are fully centralized at the ECB, while the resolution at the end follows national legal rules. And the third lesson is that burden sharing for shareholders and holders of subordinated debt could not be avoided, but public resources were spent for compensating holders, mostly households, of subordinated debt held by households. So while initially the compensation was done under narrow conditions, now the broader provisions in our budget laws for 2019 makes me worry, because it looks like it's going to be sort of a blanket compensation for losses of bondholders and even shareholders, and this would be in clear violation of the European rules. So this is obviously problematic. Too much flexibility and this kind of hybrid situation of regulation at the federal level and resolution at the national level de facto. Obviously, it is a problem in an integrated market where we should have harmonized laws on bank liquidations. Okay, we need harmonization for the functioning of the single market. Moreover, what is considered in the public interest, obviously must be based on the same criteria at national and at the EU level. Otherwise, with public support used differently, there will be issue for the single market and different funding costs in different countries related to the country's fiscal capacity to deal with their banks. So at the origin, I think so this leads me to reflect of what are the big problems of the new regulation. Sorry to be so blunt, okay? And so in my view, there are 4 problems. The first one, I think I agree with Matthias, is something that Matthias also said, that to go from bailout to bail-in was probably in this kind of to think that to have bail-in rules would have solved the problems of moral hazard that we experienced during the crisis was probably naive. Bail-in cannot be a plain substitute of bailout. In a banking crisis, we should think of bail-in and bailout in complementary ways. So that's the first problem. The second problem is that in reality there is no clear framework for resolution which ensures a plain level field. In fact, the resolution board is not really capable of putting banks in resolution. Sorry, I'm talking under your eyes, and this, I think the Italian situation actually has shown that at the end, the national level prevails. The third problem, which I think is going to be especially problematic if a new crisis, if we will have to face a new systemic crisis, is that this piecemeal approach to deal bank by bank, it doesn't work because of contagion, because the banking crisis is always about correlation and contagion, and so we should have some tools to deal with banks in a kind of, more comprehensive way. And the fourth problem is that the rules for compensating creditors are not clear. Okay, this may be something that in principle can be solved. The problem in Italy maybe was that, the new rules arrived when Italy was still in a transition, so the cost of the crisis had not been digested. I think that the new rules with 8% and, pushing for more junior long-term claims, goes in the right direction. But, still, I think it is very important that, we take we enforce these rules, and, maybe the next crisis will come when the transition issues will be solved and the new rule be in place, but, okay, so that maybe. And then for mis-selling, it is clear that the ex post compensation approach can only be justified as a solution aimed at remedying specific cases of misconduct, but a blank restoration of losses, is really not in the spirit of the new rules. Let me now just say a few words before concluding about the resolution mechanism in general. And part of the problems of what I just said is that actually the resolution authority is relatively weak. And the reason is that its governance is weak, it's intergovernmental, so that decisions can be blocked. And the second problem is that it really needs to rely on national authorities. The legal basis are national. And And so this is the other fundamental issues of his weakness. The resolution authority has also no resources for facing a major event. I mean, this was not really, problematic in the case of Italy, but if we think of a new crisis, this could be problematic. So the resolution fund is small, and and because of the decision process, it's unlikely to be able to act in a timely way. So in crisis, this structure that we have put in place is likely to be inadequate. There is no framework agreement, for example, between the ECB, the Eurogroup, and the resolution mechanism, which allows to organize provision of temporary liquidity for banks in resolution. And the backstop is subject to approval of national parliaments. So this, will impair its effectiveness. So to conclude, if a new crisis strikes, I think we have the illusion to have put, EU collective responsibility to deal with a systemic crisis. But at the end, I think that if the Italian case has a lesson to convey, is that the national level will prevail. And so the federal instruments are still very weak. So we need to reinforce the resolution mechanism. We need, from the legal point of view, and to give the EU, I think, executive power. But I think this would be very hard to do without a fiscal union and the democratic accountability for that. So it would be a long journey. And I think in the meantime, we remain vulnerable.
Thank you very much. So maybe I pass the word to Tom de Shane.
Okay.
Is that okay with you?
Okay, yeah, that's fine. Can everybody hear me? Okay. I am Matthias' successor in the supervisory board of the SSM, where I had to fill big shoes. We come both from different angles. As Jan said, I used to be a banker, even an investment banker before. Matthias an academic, but I agree with everything which is presented. I just wanted to add somewhat to it, because Matthias mainly focuses on financial metrics to judge whether banks are more sound. I wanted to look at some of the progress that's been made in terms of supervision resolution since 2008, and some of the things that are still to do. And if there's some time, I'm going to say a few words about this dreaded M&A topic as well. So if I look at the list of some of the things that we have realized since 2008, the list is long, and it only makes me realize what a mess 2008 was. Matthias mentioned the financial metrics, the size of the balance sheets. In fact, sometimes I think it's good that we had a banking crisis in 2008, because the balance sheets were growing so fast that if it had happened 5 years later, I don't know how we would have dealt with it. So the balance sheets in almost any countries on aggregate of banks have decreased, which is also a function of a simpler, more boring business model, so that's good. The solvency, as Matthias said, has improved, although, as he also alluded to, the leverage of European banks is still way, way lower in terms of the solvency than American banks, and I will come to that later. Liquidity has improved a lot, because in 2008 we had this hypothesis that there would always be an interbanking market that would provide liquidity to banks, and the idea they could dry up suddenly did not even come to our minds. We now monitor banks much more closely. And then finally, in terms of financial metrics, return on equity, as Matthias said, the Belgian banks have a healthy return on equity, on average close to the cost of equity, which is important, because if banks don't make enough money, then they can't create the necessary capital to increase their lending. So the numbers of the profits that you see in the newspapers of banks look very big, but it's important, because if they don't make profits, they can't continue to lend. But it is also a fact that the return on equity of Belgian banks is way above the average of the Eurozone, and in most countries in the Eurozone, banks do not make enough profits, and we'll come back to that later. But there's a whole host of other areas where we've made progress. there is a single rule book now. In 2008, there was a patchwork of national rules which allowed banks of very different quality to continue to operate, and sometimes we weren't aware of the differences. The supervision is now, at least for the 120-odd largest banks, is now conducted from Frankfurt by the single supervisory mechanism, at the top of which sits the supervisory board, where each country has one representative. So the national bias should have been greatly reduced by that. So that's definitely progress. We also now do much better stress tests than before. Some of you, not the students, but the others may remember the infamous stress test before 2008 where Dexia passed with flying colors. Today that would be simply impossible. We also do stress tests now for the first time on the liquidity of banks. Models. Matthias mentioned this, that banks can choose between either a standard model, a standard approach to determine how much capital they need to have for their assets, or if they think their risks are less, they can develop a model and prove that they actually need less capital. And what we've saw at the time of the crisis and initially after it is that there is some gaming going on. So by developing better and more aggressive models, banks could save on capital. What do we have now? We have also, within the Eurozone, we look at the models of the banks with the same methodology to make sure that the bar is as high in each country. We have the TRIM, the target review of internal models, which is just finished. And then, as Matthias mentioned, in Basel it was agreed that these models could never come up with a capital or risk-weighted assets that was less than 72.5% of what the standard approach would have given. Inspections at banks are now also carried out according to common methodology throughout of the Eurozone, because that clearly wasn't the case before. Governance, in 2008, the boards were not equipped to deal with these crises. They probably did not understand the risks well enough, and what was required of them was also much less than today. So there's definitely a big step forward. Then, in terms of recognition of risks, banks now are much more closely monitored, whether they have enough provisions, whether they're covered for their risks. There's also the introduction of IFRS 9, which forces banks to, from the day one, when they grant a loan, to already set aside some provision because there's a risk. There's macro-prudential buffers, because if you look at history, probably half or more of all banking crises originated in real estate bubbles. We now monitor that much better than before, and if necessary, we can also require banks to have extra capital. And then finally, derivatives markets. In 2008, we probably didn't have a clue how everything was connected. Today, with the system of CCPs and collateral, that is much more centralized. Doesn't mean there are no risks anymore, but at least it's much more, much better organized, and the risks are less. Those are all things which we've realized since 2008, and it's a long list, and that actually would lead me to the conclusion that about half of the work that we had to do has been done, although new risks are popping up all the time as well. Of the list of the things that are either partly finished or in their infancy, I wanted to mention the following. MREL, Matthias referred to this, is that with the new world where we want to bail in instead of bail out, the banks have to have bigger cushions in terms of subordinated debt. The principles are there, but the implementation is not there yet, and as long as that's not the case, that's clearly a risk factor. Non-performing loans. Non-performing loans basically means that a loan which hasn't been repaid for 90 days. This is not an issue in a country like Belgium, but believe it or not, there are certain countries in Europe where until not too long ago, 1 in 2 loans was non-performing, which means you live in the street and every second of your neighbors hasn't repaid his or her bank. This is, of course, a heavy toll for banks. But again, there's progress. These NPLs have reduced by a quarter in the last 2 years or so. Then there's resolution. I'm not going to dwell on this. I completely agree with what Lucrecia said. This is unfinished business. I wouldn't say it's in its infancy, but it's certainly not mature. And I'm in the SSM and not in the supervisory board, so you didn't need to worry. And we've been lucky so far because the biggest case, which was a Spanish bank, is called Banco Popular, which was a bank which was losing cash so quickly because customers were getting nervous. It was put in resolution, and during one weekend it was basically sold for €1 to Santander. Before the weekend, on the stock market, it was worth €2 billion. Its subordinated debt was also worth about €2 billion, and both of them were sold for €1 over the weekend. And on the Monday, the customers, when they went to their branch, found out that they had entered a Santander branch. But we were lucky because there was a buyer there which was prepared, willing to take the risk. We will not always be as lucky. Some of those resolutions in the future could be very, very messy. So for me, this is unfinished business, but at least it's past its infancy. Cyber. In 2008, cyber wasn't a big topic. Today, this is a bigger and bigger risk for banks, and we're now starting to do things like organizing ethical hacking at banks. There's a program called Tiber, which is inspired by what is done in the UK, and in the Eurozone, the Netherlands and Belgium are already conducting this, and I expect this to be the case soon in other countries. The doom loop, Matthias referred to this. Now I'm coming to the category of the problems that haven't been resolved at all, that are probably not even in their infancy. The doom loop is a major problem. So banks investing way too much in the bonds of its own government. And if you take a case like Italy, if the markets get nervous about Italian government bonds and the spread goes up, that automatically has then repercussions on Italian banks, even if those Italian banks are sound and solid. Anti-money laundering, very big topic. We've seen a case of one bank which was suddenly closed because in the United States they found out that this bank had conducted certain transactions which could be qualified as financing of terrorism. So this is a major topic. You read about this in the newspapers each week. Unfortunately, within Europe, each country guards its anti-money laundering supervision very close to its chest because the practices and the philosophies are very different. And honestly, I think we will have to sooner or later move to a situation where there's at least some more consistency and organization at the European level. Big tech. I'm waiting for big tech to move into the banking business. PSD2, so open banking for payments, maybe the door that opens it. That clearly makes our banks vulnerable in some of their most profitable business. Capital Markets Union is nowhere near realization in the European Union. We are way too dependent compared to the United States on banks for the funding of the economy. But we're not there. And then we're getting close to M&A, overbanking. There's clearly a problem with overbanking in the European Union, but I think it's different from what many commentators say, is that I don't think we need bigger and more cross-border banks. I think it's at the lower end of the scale where a number of, I would say, less disciplined or less price-sensitive banks like cooperatives, and not all cooperatives, but many cooperatives, smaller banks, that actually distort the market. And so what we need to see is a reduction, not at the very top of the banking sector, in my view, but below that. It's hard for us to imagine in Belgium that there are countries like Germany or Austria or Italy with more than 1,000 banks, many of which are so small that it's difficult for them to price risks, and I think they have a negative impact on the profitability of the overall sector. The good news is that you see a steady decrease, so there are mergers taking on at the small end of the scale in Germany each year. There are maybe 50 less small banks. In Italy, a law has been voted, I think, to make it more easy for cooperative banks to merge. Spain has gone a long way in this, which is one of the reasons, I think, why the Spanish banking market is much more healthy now than a number of years ago. And then we finally come to the Holy Grail, which we haven't seen yet, is EDIS, is European Deposit and Guarantee Scheme. we're actually right now, the big perspective is that we're in a project which will take maybe half a generation, where we start with putting banks under common supervision so that the bar is the same for all the banks, and that we can have, again, trust in the banks of other countries. But at the end of that, we will have a European deposit scheme. But today, not all countries within the Eurozone are comfortable with footing the bill for a deposit scheme if banks in other countries aren't as safe. So we need to actually bring banks all over the Eurozone to a comparable standard before we can have that deposit scheme. Today, while we are waiting this, the deposit schemes are national. So we have this odd situation that the decisions on banks are taken in Frankfurt or in resolution in Brussels, but if it goes completely wrong, the bill to pay back depositors is national. And this is, of course, I find this somewhat unnerving, but unfortunately we need to go through this stage. But that then brings me to the last topic, which is this M&A. So the track record of cross-border M&A is dreadful. Within country M&A is not that much better in terms of synergy, and I say this as an ex-M&A banker, so I am skeptical. The other argument that we need bigger banks in Europe, I'm skeptical as well. Okay, the top 5 US banks are bigger than the top 5 European banks in terms of assets, and way bigger in terms of valuation, but the valuation is because they simply have more capital and they're more profitable, so I don't think that's a good argument. But if you look slightly further and you look at the top 30 banks in the Eurozone and the top 30 banks in the US, in fact, the sum of the 30 Eurozone banks of their balance sheets is bigger than in the US. So I don't really think that we have an issue of scale at the top end. Now, about the arguments, I will not talk about all the arguments that Mathias gave. When banking goes well, then of course it's okay to transfer capital, liquidity from within the same group from one country to another. But if it goes wrong, then it's really each country for its own, and it is mainly because these banks are organized within a group as legal entities. And legal entities are the only thing that insolvency law knows. And that is why I think, as a principle, as long as we don't have a European deposit scheme, I quite like within banking groups there to be bulkheads, because no banker on the planet can guarantee that his or her bank will never have a crisis, and therefore we need to take them at their word, and we need to have bulkheads until this capital union is ready. So this capital union, which consists of 3 pillars, the SSM, which has existed for 4 or 5 years, which I think is in cruising speeds, the SRB, or the resolution, which in my view is past its infancy, but not at maturity, for the reasons that Lucrezia has very eloquently addressed, and then EDIS, which is nowhere near. So that's another reason why I say the job is about 50% done. There's another 50% to go. It'll be tough, and at the same time, new risks are popping up. So the banks are sounder, but we're not there yet.
Thank you very much. Professor Daams?
Let me first of all start by congratulating Mathias Dewatripont for the award he receives this afternoon. I think the University of Antwerp can be very proud to have someone of his stature as an honorary doctorate, and I'm really proud that you got the title. I also want to congratulate you, because I was expecting a paper that was a little bit more critical of the Belgian banks, and I found the questions very good, and I found the questions very well treated. And I would really like to challenge you to use the presentation that you've done today as a background for a book, maybe not one of your very academic books, but a good book to explain to everyone in Belgium that indeed there has been some progress on the improvement in Belgian banking, because when I read the public opinion, the only thing that I hear, and also from some economists, that nothing has changed. And I can tell you that a lot has changed. The one comment, Mathias, I had on the on your introductory slide, where you suggest banks are basically liquidity providers, I usually would argue that they are a little bit more. They do the transformation from short to long term. They do the risk management, because they do not give money to people who are not creditworthy, and they do the allocation of capital in the economy. And I know, as an excellent economist that you are, a lot of these things can be done by the market, but please do not forget that even if they are done by the market, the risks do not disappear, as the example that Tom has given on Spain clearly illustrates. The market bears the risk of the resolution. But let me end here the introduction on the comments I was going to make. The second set of comments that I want to make is on, and I've been now a bank chairman for 10 years, since after the crisis. I was there during the crisis, but not as a bank chairman, but someone cleaning the hallways and just doing some background work. But now, having been a bank chairman for 10 years, I have learned a lot of things, and I've seen a lot of things. The first thing, when we took over Fortis, and Fortis became BNP Paribas Fortis, we reduced the size of the bank. Now, you may say, well, it's relatively easy, huh? No, that's not easy. And I think we were extremely fortunate, and that is an argument for what Mathias has said. One of the advantages of being within a large group, the BNP Paribas group, it was very easy to restructure BNP Paribas Fortis, because you could get rid of a number of the activities, like, for instance, the United States and so on. You could deal with Turkey and merging Turkey with the activities that BNP Paribas had in Turkey. And so the transformation process was a lot easier than when we would have to do the transformation process on our own, and trying to shrink the bank and trying to find a buyer for every activity separately. So all this went very smoothly, went very easily. Liquidity was something that preoccupied us quite a lot. Risk, and in giving credits, I think went very easy, because BNP Paribas Fortis had a long tradition in evaluating credit risks, and the companion bank ASLK also had a long risk, and so that went very smoothly. And as you can look today at our results in credit cost, they're one of the lowest you can think of. And by the way, and I think Tom referred to that, we should always remember that the Belgian banking crisis had nothing to do with giving credits to poor performing banks, but had a lot to do with something that Mathias referred to, is the fact that maybe there were acquisitions that were not carefully considered, and there was the unfortunate development in the United States with the derivative markets there. Also things that we have changed, and on things I personally spend a lot of time on, is on remuneration. I spend a lot of time on remuneration. That was not to be a role for the board, because this was always treated by the expo. The regulators have wanted to be that the board took a serious interest, and we have done that. We have also, and this was very important, because you know one of the critical variables in a bank is the cost-income ratio, and all of you, I'm not telling you any secrets, all of you know that BNP Paribas Fortis does not score too well on cost-income ratios, and we're not one of the best in, this is the typical British understatement, we're not one of the best in Belgium on cost-income ratios. And so we have been looking for alternative activities to try to deal with that. And so we have taken up one activity that we had stopped, namely private equity, and we're doing again some private equity activity in order to push up the return. And we have taken over, and that's been a very successful acquisition, we have taken over the leasing activities of Arval, and Arval is one of our key players. We have also, and very importantly, and I think this is one of the key things for banks as we are, because we are basically worldwide, or certainly a European-wide, but also worldwide retail bank with some investment activity attached. We've spent a lot of time and a lot of effort on customer satisfaction, and there is not one board that I can remember that we did not discuss customer satisfaction. And then you have the digital revolution, and I can tell you the digital revolution is indeed a revolution if it's not a tsunami. This thing is incredible, and you have seen us in the news last week or the week before, where we had to close down a lot of the, or we will close down a lot of the branches of the bank. And as I think Mathias has very clearly pointed out, in Belgium we're way behind, and people scream now, but we're way behind in comparison with the rest of European countries. I'm not going to divulge the number of turnover, or the number of people of the turnover we have per branch, but I'm not going to ask you to raise your hand, but think in yourself and ask yourself this very basic question: when I was the last time in a bank branch? And you will all discover why we need to close bank branches. Because no one, not one here in this room, never anyone goes to a branch bank. Now I want to come to my last set of comments, and that's on cross-border mergers. And I must tell you, I was so happy with what I was reading with Mathias. It's the first time that I I feel a little bit at ease. Usually I'm in a defensive position when we're talking about cross-border managers. Now at least I felt a little bit at ease. First of all, the term cross-border mergers. I find that a strange term, because we're typically talking about mergers in Europe. So there are some Europeans who don't consider that cross-border mergers, because that's European mergers. What's the difference between France and Belgium? What's the difference between Belgium and Germany? There are differences, of course. They speak German, we speak, I don't know what we speak. With the French we speak at least some French. But we need to rethink a lot of these concepts. And of course there are differences in regulation. But I can guarantee you, the successor of Mathias, who is going to receive an honorary doctorate, he will tell you that, well, 10 years ago there was this award to Mathias, and then at that time we were still talking about national regulation. National regulation in 10 years does not exist anymore. I'm sorry, Tom, for your job. Yeah, I'm sorry for your job, but the national regulation will totally disappear, and you will only have Frankfurt regulation. Today, when I deal with the regulator that's, for me, is a post office which is called the National Bank, and you drop letters there and they travel to Frankfurt. And you get, via the National Bank, a reply from Frankfurt. But everything, for me, happens in Frankfurt, except the FSMA, because these guys don't have headed at the European level. But to summarize, I'm happy with what Mathias said on the cross-border mergers. But let me explain why. I've already said one of the advantages is that you can restructure much more easily within the bank. And first of all, let me say, and this is what cross-border banking really makes difficult. I guess I want to do a test here, but I'm not going to do it, not to bother you. Probably a lot of you think BNP Paribas Fortis, that's a bank operating in Belgium. You could not be more wrong, because we are in Luxembourg, we are in Turkey, and we have a minority stake in Poland. So we are cross-border from the beginning. So the concept of cross-border is something that is very strange, because you mix banks that already have foreign extensions among themselves. Now, why is cross-border banking, and I'm not talking about the banking side because I'm basically a businessman, I'm talking about what the advantages are for business. And I can tell you, it's not a surprise that we have the largest share in the larger companies, because the larger companies need a European-wide operating bank, and they are happy with a local bank that has some banking relationships across border. So they find that happy. Is cross-border banking working as it should? In no way. And I think we're treating with the wrong, we're looking at cross-border banking with the wrong eyes. We're looking at size and so on. A good eye is the diversification that you create. But when I see cross-border banking, I see loads and loads of opportunity. We have not even begun. We have not the start to creating the real synergies that exist in cross-border banks. Let me give you a personal example. I am a customer. Where do you think I am a customer? I'm a customer BNP Paribas Fortis. I am also a customer with my mother company, BNP in France. Do you think when I use my cards and I try to log into their systems, that is easy for me and easier than my French neighbors? No, it's completely different. The whole system has no comparison. And so, trying to get these synergies together is going to create opportunities for efficiencies in the banking system in Europe that are incredible. Really incredible. Before you get too enthusiastic, I can also tell you about some of the negative points. Because we had a failure in the computer system in Paris. Should not tell you while Tom is in the room, but we had effects of that even in Belgium, even in Luxembourg, even in Turkey. So the cross-border banks have some difficulties. But again, that is an opportunity to design computer systems that at least in the front end are accessible to European, and I'm not talking to French consumers or German consumers or Belgian consumers, but to a European consumer. There are loads of opportunities, but there are also a lot of dangers of trying to get to that. I'm coming to my last point. And my last point has to do, is a direct application of cross-border mergers. What has happened, and you all economists think, I'm an economist myself, but we used to think that the world was simple. And in the sense that we had judicial entities in different countries, and you merged these and you had a cross-border bank. I'm sorry to tell you, that's not the way it works. But the regulator continues to believe that it works that way. It does not work that way. Let me tell you a little practical story, just to make you understand the problem. The story is a little bit complicated, but I'll tell you anyway. Brussels, BNP Paribas Fortis, as I've told you, that's the reason I told you, we have a bank in Turkey. And the bank is under our judicial control. So as a chairman of BNP Paribas Fortis, I'm proud to tell you we have a bank in Turkey. We have a bank in Turkey in the legal meaning of we have a bank in Turkey. Do I have to tell anything in Turkey? Well, if I'm nice and friendly and I chat up my colleague chairman, I might be able to have some contacts in Turkey. But the whole organization of that bank, which belongs to the international operations and not to the market operations of the group, is driven by France, fortunately by Belgium. But it is driven by France, but the Belgium has nothing to do with my organization. He is outside that. So a lot of the decisions that are made there fall not under the hierarchical control of me or the CEO of the bank. And that is creating a huge problem, because the types of organization and judicial structures do not go. Nevertheless, when there is something wrong with Turkey, who do they call? I'm trying to have little business cards and say, please call Paris. No, they also always call me. And I'll give you an example on what they call me. The Belgian banking legislation has a provision that no one in the bank can earn more than 50% of his fixed base salary. I'm supposed to impose that in Turkey. I cannot impose that in Turkey because they are not under my hierarchical control. And I only have 50% of the shares. Who can you, as a shareholder, intervene there? Nevertheless, every year I'm told that the variable remuneration in Turkey is not compliant with what we should be doing. But what can I do about it? And I think we really need to think much more carefully about how we deal with the organizational structure and judicial structure, and that the regulators have to take that into account. This might change if we drop the national regulators completely and move completely into a European regulator. But as long as we don't do that, we have a problem. Thank you very much.
Thank you very much. So thank you very much, everyone. So before we go to the Q&A, maybe I'll give a short word to Mathias to comment on certain things that might help the Q&A session, maybe.
Thank you, Jan. Thank you for three very nice discussions. I think I fully share Lucrezia's assessment about how Italy, with the help of the institution, managed to get around an unreasonable at the time ERD. So I think it was much better to go through the loophole, even though it didn't look clean, than enforcing a BRD rule that could have created at the time financial instability. The road is clear. I think we're getting there to some extent, which is to make it possible to properly implement that rule, but until we are able to do it, better to implement it. In that sense, Belgians and Italians are a bit the same, pragmatism. Concerning Tom's assessment, I fully agree that about what has been done, about what still has to be done. I think maybe my only kind of a caveat is to say that I think given that BRD has given such priority to the deposit insurance scheme, I'm not sure it will be necessarily a game changer to have it, because today, since it's so super senior, I don't think the risk is that important, and at times I'm a bit surprised that on the one hand the European Commission and on the other hand Germany are so excited about this, but okay. Now concerning Herman, who said he agreed a lot with what I said, as a former supervisor, I'm asking, am I too nice to the bankers? I don't know. But I think, shall I say that I also like it that the banker is saying that what I'm saying is okay. So I think still, I think the only point I would like to maybe comment on and introduce some disagreement on this issue of the challenges of banking. I think what your description of the problem of Turkey for Fortis and BNP Paribas concern. And the first question is, to what extent isn't that a bit of a self-inflicted problem by BNP Paribas? If indeed France wants to control Turkey, maybe have the Turkish activities directly legally under French authority more than Belgium. And on this issue of the limit of bonuses and of variable remuneration, which are indeed stricter in Belgium than in Europe as a whole, so it's 100%, I don't know about Turkey. I think that, to me, the best would be to have everybody at 50%. I think, these things are the result of interaction between various stakeholders, let's say. And there is one question, to what extent can national authorities kind of insist more on the prudential requirements? I think there is currently a compromise that in particular on macro-prudential the national authorities can be stricter. And I think that's not a bad compromise at this point, because indeed, depending on the system, some banking systems can be more dangerous for some economies than for others. And by the way, if you want to circumvent these questions altogether, you can always turn a subsidiary into a branch. Comment on that, but that I think is of course a way out of the potential hurdles. Thank you.
So let's move now on to the Q&A session. We still have like 13 minutes for a couple of questions. There's a question over there. We have can simply hold this catch box and then speak in it.
Okay. First of all, congratulations to Mathias. I'm Joost Wingedo, and I had the privilege to be Mathias' deputy for 6 years. It's a bit a dull debate. Everyone is in agreement. But I would like to react on the cross-border dimension and one with an observation and one with a question, but Mathias in his last intervention already alluded to that. I think that the whole problem with cross-border banking is that for the time being, banks are international in life and national in debt, and that's part of the whole problem linked to that. But the mantra in Europe is very much, and Mathias alluded in his presentation, that there are impediments to cross-border banking, that there is fragmentations, that some national authorities are ring-fencing and by requiring national requirements, national capital, liquidity, and other requirements, and that are the bad guys, that are not the good Europeans, because they have concerns on the stability in their national market. But as it has been said by Mathias in his presentation, before the financial crisis we had cross-border mergers and acquisitions. Not all of them were very successful, as we know. And Tom pointed rightly out that at that time the framework was less harmonized. We have now a single rule book, so all the instruments are in principle available. So one observation is, I think it's more linked to the lack of economic added value in having these mergers and acquisitions, that we have to look at the economics. And as said, the profitability, not in Belgium, the repair of the Belgian financial sector is remarkable, but in Europe, the profitability is subdued. I think that's the main reason why we do not have more cross-border banks in Europe, especially in the context of, as Thomas said, an unfinished banking union. And that's more an observation. A second, and that's more a question, and especially also to Professor Dams, and Mathias alluded in his last presentation, there is an instrument in Europe which is available for having cross-border banking, and that's branchification, that's branches. Why international operating banks in Europe do not use that instrument more often? Then you have not that problem between the balance between the home and the host, between national rules and European rules. And it's available, it's part of the acquis européen, so that's something I do not really understand why it's not used more in Europe. Thanks.
Please go ahead.
You have to understand that, and that's because I have a long background in outsider banking, that creating cross-border mergers, as a lot of the people also here in the room who have worked in trying to get these cross-border mergers going, that it takes a lot of time to get these things really where they need to be. Personally, I believe without cross-border mergers, banking will have a hard time surviving. The basic cost of compliance, the basic cost of the computer infrastructure, the whole digital revolution is so aggressive that you cannot survive without the cross-border activity. But it will mean that it takes some time. More, it's not because you sign, that's what a lot of investment bankers often think. You sign, and it's the closing of the operation. So the merger is a fact. No, the merger is not a fact. The merger is a fact after 5, 10 years, when you work together, when you put computer systems together, when you put products together, when all these things comes together. And your comments, very well made, on branches, I understand. But not today. If we were saying branches, the whole of Belgium would be up in arms, saying, come on, you cannot be serious about this. But this will take time. And I'm sure that the banking system in 20 years' time will look completely different. But you have to appreciate that the managerial challenges of putting cross-border banks together is much more than just signing a couple of papers and putting the thing together.
Okay.
And that's the same thing, Matthias, on Turkey. There is a lot of history and legacy behind these things that does not appear immediately. But in the meantime, you have to work with regulators that have a hard time understanding these things.
Matthias, want to say something? No? So maybe one more question. Yes, please. Maybe from the students' side as well. Don't hesitate to ask questions.
Thanks a lot, and congratulations, Matthias. My name is Jan de Wit. I'm heading the dealing room of National Bank of Belgium. I have two very brief questions. In highlighting the potential benefits of cross-border banking, you start with the ECB argument on improving the transmission of monetary policy. Basically, I deem the argument being flawed. I mean, there is no impediment towards the circulation of liquidity on the constellation, in my view. So I would appreciate if you could elaborate how you see this functioning more concretely. And the second question I would like to raise, the current situation with more focus on bail-in when it comes to bank debt instruments. I mean, MREL is incomplete, as Tom correctly highlights, but still these instruments are created and are being priced in markets. And I was wondering if maybe either Matthias or Tom has a view on the correct pricing of bank risks in different market segments nowadays, specifically referring, for example, towards the kind of smallish spreads between preferred and non-preferred senior bank debt. Thank you.
Okay, thank you. Maybe definitely not be complete, but so on this issue of transmission of monetary policy, it is true that of course the ECB has had to go really big length in order to improve credit supply in Southern Europe. The extent to which in the near future this can be done partly through cross-border banking, I think will remain limited the next couple of years, because you don't see many things happening at that level. There is little activity. Let us see now whether this Commerzbank, Deutsche Bank thing will lead to other things. It's fair to say that there may be a question of consistency of institutional setting, because even if you have some of these cross-border banking, you can have limitation of these things if the host country is worried about what's going to happen. So I think that it's a long shot to hope that within the next couple of years this will be a decisive element on that front. Then on the issue of pricing of bail-inable instruments, I think that of course the resistance right now, the fact that 3 years after the introduction of BRRD and the 8% rule, we are still not ready to implement it because we haven't issued all these bail-inable securities the market. That's a reflection of people understanding that these things can be risky, therefore it will be more expensive, and therefore banks would rather not issue that stuff and keep being funded by cheaper means. And the reason it's cheap is because people think that they will be protected, and therefore they are ready to have a lower return. Now, then next to that, there is the other thing about the credibility of the bail-in and so on. As we know, if markets think that the rules will not be respected, then they think, okay, they will be bailed out, so they are happy to receive a lower return. So markets always have, there is a risk of multiple equilibria. So in 2006, 2007, the interest rate on 10-year Greek bonds was the same as, almost the same as on German bonds. So, and indeed, if nobody panics and so on, then it can go this way. So it's a bit like the whatever it takes, that a bit of a magic, because this moves things to another equilibrium. So I think that there is therefore uncertainty about the pricing, but I think as I say, the resistance suggests that gradually people are thinking, okay, if the credibility of the bail-in rule becomes clear, then we will more correct assessment of the